Welcome, and thank you for joining us today for our presentation on relocation planning for U.S. immigrants. I'm Carolyn Powell, Business Development Director here at Tronconi Seguer & Associates, and I'll be your host today. There definitely has been a growing interest from Canadian individuals and business owners that are interested in moving or retiring to the U.S. This then brings up the conversation of immigration considerations, but also tax consideration. Doing your homework before you move and transition will make things smoother for you and shed light on how best to move forward with your long-term plans. Every situation differs, but today we'll give you some general information to get you started with things to think about, and we're happy to set up a call to further discuss your specific situation and concerns. We will provide David and Rosanna's contact information today so you can reach out to them directly to set up a meeting, and we'll leave time at the end for Q&A. So let's get started. Rosanna Berardi is the managing partner at Berardi Immigration. Berardi Immigration can help you make the American dream a reality. They help their individual and corporate clients navigate the ins and outs of immigration law and the application process. Rosanna has over 25 years of experience in immigration law and has helped hundreds of people with their immigration needs. David Lever is the principal at Tronconi Seguer & Associates. Tronconi Seguer & Associates is a full-service accounting firm whose mission is to provide the best and most appropriate and professional tax, accounting, and international consulting services in the industry. David has dedicated his career to international and domestic tax and has experience in helping both Canadian individuals and businesses locate and be tax compliant in the U.S. Rosanna, do you want to get us started today?
Everybody for joining us. There's certainly a lot of things to talk about in the world of immigration. So my job today will just be to give you a high-level overview of how things work at the border, even though most of the border has been closed for the last 18 months, and give you just some ideas to get started in terms of making that entry to the United States. So first things first, people will call all the time and say, I'm not quite ready to move to the United States just yet or open my business, but I do want to come in and look around. I want to, look at some properties. I want to talk to lawyers. I want to talk to bankers. Can I do that? So let's answer that question. Do the next slide. Thank you. So in order to enter the United States, to do those things, to look around, to go to meetings, trade shows, conferences, we look at the B1 category. The B1 is just a designation under the Immigration and Nationality Act. It's typically used for business visitors. There's also the companion category called the B2, and that's what most Canadians use when they enter the United States, whether you realize it or not. So right now, it's kind of strange times with respect to entering the United States, particularly for Canadians. So if you want to come into the United States to do superficial business activity, right now you can only fly into the United States. You cannot drive across the border. You will not be admitted to the US. But if you fly from Toronto to Miami to maybe look at a property to expand your business or to talk to a lawyer or maybe an accountant, you can certainly do that under the B1 category. You can't be paid for any of the work, and you can't do anything hands-on. So you can't start working, you can't start planning, your business strategy and such. You have to just be looking around and observing. It's always a good idea to have a round-trip ticket when you do this, and to show that you have permanent ties to Canada, meaning property ownership, a job to return to, credit card statement. That's not something that you would just show the government upon asking for admission, but if they did ask, it's something good to have in your back pocket. So for business visitors, you can come in by air only right now to do the superficial business activities. So what are best practices for crossing the border? I've been doing this for almost 25 years, and the best advice I can give to prospective clients is your job is to make the inspector's job easier. You need to be prepared. Look at the expiration date on your passport, on your Nexus card. It's been a long time since we've crossed that border. So dust off those documents, make sure they're still valid, have them ready to go, and make sure that you do have proof of ties to Canada, as well as evidence of what you're doing. Now be careful with a company letter. Some people say, well, I'll just have my company say I'm going in to look. Those letters have to be very carefully worded. So I wouldn't use those unless they're professionally reviewed by an immigration lawyer. And when you are entering the United States, I would also recommend staying away from the words working or doing anything hands-on. Those are the words to avoid at the border. They definitely will open up a can of worms. You really have to sell yourself as just someone coming in, observing, looking at things, and trying to make decisions. So again, make it easy. When you pull up to the inspection booth once the border reopens, or you're at Pearson Airport, have everything ready. Don't start digging through your suitcase or your carry-on bag. You're going to annoy the inspector. Have everything ready in a neat folder. Know where you're staying, know the address. Make this simple and easy. Treat it like you would a job interview. Look professional, be courteous, and mostly be organized. That's the best tip I can give you for crossing the border. So COVID is still a thing at the border. On Monday of this week, August 9th, the Canadian side of the border opened to US citizens and American green card holders. There's a lot to do if you want to enter Canada now. You're required to download your vaccination records in the ArriveCan app, and you do have to get a molecular COVID test within 72 hours of entry to Canada. Even if you're fully vaccinated, you have to have proof that you're COVID free. You can do that a variety of ways in Western New York. Erie County has a test center set up, as does Walgreens, CVS. There's a couple private companies that do rapid, there's one called Western New York Rapid Testing, but you can't do the rapid antigen test. It's gotta be the molecular test, so it does take some careful planning. If you're a Canadian and you wanna drive across the border, you're not gonna be allowed to do that. They're only allowing essential workers to come into the United States. So if you do have a work permit of some sort, you can certainly come in. But if you're coming in, you know, to meet with someone or to visit your family, that's still not permissible on the land side. It's only permissible if you fly into the United States. And also know on the Canadian side, although Americans can enter, the Canadian government still wants you to have a quarantine plan. It doesn't mean that you're going to have to quarantine in Canada for 14 days. All that means is that if for some strange reason you got COVID while you're in Canada visiting, you would have some place to go. So what do you put for that on the ArriveCan app? I've had clients put hotel addresses, friends or family addresses. When I went over on Monday, I put my cousin's address because that's a place I could park myself if I had to for 14 days. So the quarantine is over in terms of entering Canada. And just know when you're coming back to the United States, as a US citizen, you cannot be denied entry, and you do not have to have any type of COVID test or vaccination proof. So there's inconsistencies on both sides of the border right now, and it is confusing. So if you are planning to make a trip, it's good to do your homework ahead of time and make sure you're prepared. So how do you know if you need a work permit? How do you know if you've crossed that line beyond the B1 visitor status? Well, the government looks at a few different factors. If you are a worker in Canada and you have direct reports in the United States, that would most likely necessitate a work permit. If you're traveling to the United States frequently, more than once a month or a few times a quarter, that would necessitate a work permit. Also, if you're getting paid from a US source and performing hands-on work. Now, remote work has really muddied the waters on the US immigration law, but we're going to just keep this very clean and say if you're working in the United States, if you're physically sitting in the US being paid by a US source, you need a work permit to do that. So how do you get a work permit? Let's talk quickly about some of the various categories. So many of the prospective calls that we get are from Canadians who they want to buy a business in the United States. They have their eye on a yoga studio or a hotel that's for sale, or they want to start their own company in the United States and put up a building. How do you do that? Well, there's a category for investors called the E2, It is for individuals who are citizens of countries that we have an investor agreement with. Canada is on the E2 treaty, requires a substantial capital investment. It's not defined. This is not the immigration category that requires $1 million investment. We've done E2s for investments as small as $70,000, but you have to show that of your investment, you have a majority of that in cash to invest. No loans, no mortgages. So on the $70,000 E2 case that we did, someone was buying a small yoga studio. They had $50,000 of cash. They had a business plan showing they would create jobs for American workers, and we were able to successfully obtain an E2. If you already work for a company in Canada that has a US affiliate or operation, the L1 category is a great place to start. It was created to allow what they call intra-company transferees, which is a fancy way of saying a Canadian who works for a Canadian company that has a US affiliate to come to the United States and share their knowledge. The L1 category is a great tool for Canadians wanting to enter the US because it can be applied for right at the border. We always look at the TN category. This was created under NAFTA. And although NAFTA has now been replaced by the USMCA, the immigration components of the USMCA remain the same. So there's about 70 jobs on the USMCA/NAFTA treaty that allow Canadian and Mexican citizens to utilize in order to work in the US. So a simple example, if you have an offer from Ernst & Young in New York City as an accountant and you're a Canadian citizen who holds an accounting degree, we can get you a work permit very quickly to enter the United States for work purposes. You can get the TN for 3 years at a time and you can renew them indefinitely. So right now, the trick of my job is finding the category that you would qualify under and really figuring out the time frame of all of this. Right now, the border is still open for business applicants, meaning if you're a Canadian citizen, you can apply for a TN or an L1 right at the border. Here in the Buffalo jurisdiction, you do have to make an appointment ahead of time, and you can submit your application in advance. And when you show up, the government will review it, and if all goes according to plan, issue your work permit on the spot. The E1 and the E2 investor category is a fantastic category for business investors in the United States, but it does require an in-person interview at the US Embassy in Toronto. Unfortunately, they are substantially backlogged from the last 18 months. So right now, it's taken a very long time to get an appointment. So what we'll do for a lot of clients, we'll either utilize the TN to get them in quickly or the L1 and then ultimately pivot for the E2. So in terms of immigration considerations and takeaways, the US-Canadian border is open for business. If you want to work in the United States, we can make that happen, provided you can fit in one of the categories we just discussed. It is complicated in terms of knowing all the rules back and forth. So if you do have any questions, reach out to Berardi Immigration Law. We can certainly answer all of them for you. At this point, I'm going to turn it over to David, and David's going to talk about the tax considerations of moving or relocating to the United States.
Thank you, Rosanna. So we're going to go through a couple different slides here with, I guess, different scenarios depending on the status of the folks who are in Canada looking to move to the US. But usually one of the things that we want to consider first when you're looking at the move to the US is really your overall picture and the long-term goals that you have. How long do you plan to be in the US? If you're going to come on a temporary work visa, that gives you, there's definitely a different answer than if you're going to be looking to get green card or be on the path to US citizenship or permanent residency. And the other thing we will really look at is, what does your personal balance sheet look like? What investments do you have? Do you own a company? Are you the beneficiary of a foreign trust? Because all those things are going to matter when we try to plan to try to get you over to the US and do so in the most tax efficient manner. Before we get to this first slide, one important key here to discuss is that the US is a bit different in that it taxes you either based upon your residency or physical presence or your citizenship, which is pretty unique. Most countries like Canada only tax based upon residency. So when you are looking to move to the US, it's likely that you're going to be breaking ties in Canada, residency. And so there's going to be some implications that we'll talk about. One of the other key points is, although you could be a dual citizen of both countries, or the US in another country or Canada in another country, for tax purposes, you can really only be a resident of one country at a time. So a lot of times we'll have to take a look at the facts that are in place, where you have what's called your center of vital interests, where you might hold those permanent ties, similar to as Rosanna mentioned earlier on in the presentation. So that'll be something that we'd have to take a close look at, and is probably on a one-by-one basis that we would look at that evaluation. So in some Canadian considerations to talk about when you're moving to the US, and again, just a little caveat here, we don't practice Canadian tax. We see these issues come up a lot in our discussions with our clients' Canadian accountants, or we do work with a number of firms as well in Canada that can assist in these matters. But because Canada does have that tax based upon residency, when you leave Canada, you have a deemed asset sale, so an exit tax. And what that means is, effectively, if you have a stock or security or some type of other asset that you own that has appreciated in value that you haven't sold yet, you still own it, you may have a deemed disposition, meaning you may have to pay tax on the appreciation of that asset when you leave Canada. That's going to be Canada's last chance to tax that asset. So there's some planning that we can do that goes around with that. And under the US-Canada tax treaty, we can also tax plan for the capital gains so that you're not getting double taxed, which is really the main focus of that planning. In addition, there are some other constraints that might be placed upon you on your other investments and assets. For example, if you have a tax-free savings account, a TFSA in Canada, you can't own that unless you're a Canadian resident. So you may have to divest yourself of that as well. One of the other important things that we see that's not always looked after is, because Canada does tax upon residency, if you're going to continue to maintain assets in Canada after you leave Canada and move to the US, you really need to update those administrators of those assets that you are no longer a resident of Canada, because they may have to withhold Canadian tax. And what that'll do for you is really allow you to not have to file a tax return. There'll actually be a withholding tax that would occur for you at the Canadian level. One of the other frequent questions we get is about rollovers, my retirement accounts, my education savings accounts, so on and so forth. Unfortunately, really under the treaty really doesn't address this. So if you want to move your RRSP to the US and transfer it to a 401k, you really can't do that. So we have to talk about what your options are there. But unfortunately, there's not really a quick and easy rollover. And then in the year that you move from Canada to the US, you're going to have what's called a dual status year. So you're going to be a Canadian resident possibly for part of the year and a US resident for the other part of the year. It'll just make that really tax filing a little bit more complicated in that 1 year of transition, but certainly something that we can assist with. So in looking at that personal balance sheet, when you are looking to move to the US, if you have what's called a foreign corporation or a business in Canada that you're going to continue to own after you move down here, we really have to do a good evaluation and planning for that. The IRS, with our Tax Reform Act of 2017, passed a number of laws, and one is this GILTI regime. And I know the acronym sounds a bit funny, but what it is the minimum tax on a foreign corporation. So if you have what's called a controlled foreign corporation, which is a corporation that's owned at least 50% by one or more US persons, so US residents, green card holders, citizens, etc., that minimum tax applies to you. So in addition to some reporting requirements that would be required with your personal tax return, you're also going to be subject to this minimum tax GILTI that effectively makes sure that you pay 21%, which is the US corporate rate, on the earnings of the foreign corporation. So if you're paying a lower tax rate in Canada, sometimes Canadian businesses are qualified as small businesses, they pay low taxes, you may have to pay the difference in the taxes to the US government. In addition to that, it's a 1 year period that you're looking at. So we've found that there's some funny results that come out when you have losses that might be carrying forward from one year or the other. You can't carry forward tax credits. So there's certainly, this is definitely one area that we want to take a close look at and see if there is some planning that we can do to make your business in Canada not a controlled foreign corporation for these purposes. And it's probably something that we want to do in advance of your move. Also, we're going to have to take a close look at your foreign bank accounts and assets. The U.S., as a U.S. person, you're required to comply with the FBAR Form 114 and FinCEN, which is the IRS equivalent reporting. So if you have $10,000 or more in one or more U.S. bank accounts or foreign financial assets at any point during the year, there's an annual reporting requirement that's required to the U.S. Treasury and perhaps the IRS, depending on how much you have left up in Canada. And again, this is just a compliance issue, but there are some pretty stiff penalties for not filing these forms, starting at $10,000 a year. So definitely something we want to be mindful of. In addition, if you're a beneficiary of a foreign trust, there are also reporting requirements, and a lot of these considerations here listed on this slide really often don't amount in a lot of actual tax, but just a lot more compliance. And we just want to mitigate your exposure for penalties for failure to file, which pretty much all these forms are at a $10,000 a year occurrence. So it can add up pretty quickly, and penalties are something that we obviously don't want to be paying. So definitely want to make sure that that when we are evaluating your situation, that we're taking into account all these different areas. And then more frequently, we're getting a lot of questions about folks who are moving down to the U.S. that if they have a spouse who's a U.S. citizen and they're just a Canadian citizen, they're looking to move down here, but say that spouse who's a U.S. citizen has been Canadian resident for a longer period of time and may have stopped filing the U.S. tax returns. Again, as a U.S. citizen or U.S. person for tax purposes, you're subject to taxation on your worldwide income, and you do have to file even if you're living abroad. So usually we would file a U.S. tax return for you, and you would take a foreign tax credit for any taxes you're paying to other countries. We would also look to the treaty of the country that you're residing in to see if there's any benefits there for you as well that we could take advantage of. Again, treaties are usually used to avoid double taxation, which is really the goal. So in a situation, if you have a U.S. person living in Canada or Europe, which we often deal with as well, usually the tax rates there are high enough that you usually don't end up paying very much U.S. tax at all, but it is, again, more of a compliance thing. And again, that foreign bank account and asset reporting that I mentioned on the previous slide would apply in this case as well. So we want to do a good evaluation of what you've complied with, what you haven't complied with, and to see what we can do to get you on side, because oftentimes I usually say that there's not a lot of overlap between tax and immigration when it comes to which visas you can get and that type of thing. But there usually are cases, and this is one of them, if you're looking to come to the U.S. And the spouses, one of the questions they're going to ask is, are you tax compliant? So we definitely need to get you on side. And again, if you haven't filed for a year or a number of years or a number of forms, the statute of limitations never runs unless you file a return. So if you haven't filed for the last 10 years, theoretically, the IRS could come back after you for 10 years worth of compliance. So what we try to do is again, mitigate and cut off that risk to you. The programs that the IRS has in place now are kind of dwindling and limited, but usually with a good fact pattern, we can come up with a course of action for you to get on side. So one of the items that we frequently use is the streamlined foreign offshore procedures. So this is where you file 3 years worth of tax returns and 6 years worth of the foreign bank account reports. You come forward on a come forward basis. You file these returns. You pay any tax and interest that you might owe. You don't have to pay these penalties, which usually can get in the tens to hundreds of thousands of dollars for failure to file a lot of these forms. And then you certify that you are non-willful. So that's usually the big piece that we have to look at again. So we'll have to give a narrative as to why you haven't filed and the reasonable cause that surrounds that as to why you haven't filed. So oftentimes it could be I've been living in Canada for 30 years. I've been a U.S. citizen. My mother was, and I became a U.S. citizen because of that. And I've never filed before. and I just learned I need to file, and so I'm coming forward to do so, that type of thing. If for some reason the fact patterns don't line up great for your reasonable cause, we may get you in touch with a tax attorney to help us with that. But 9 times out of 10, I would say, usually the fact patterns usually line up that we can find some type of reasonable cause. And then for some reason, if you filed maybe a tax return, but you haven't filed your FBARs, there are some procedures that we can use to file just those extra forms that you need to file and get on side, again, on a penalty-free basis. We do have to show that reasonable cause. There wasn't one kind of subtle change to this program by the IRS last fall, and really you used to come forward and attach your statements, and usually you never would hear from the IRS, hopefully. Different than Canada, where you're used to getting all these receipts of filing and whatnot. Usually no news is good news from the IRS when it comes to filings, and they're going to send you notices if there's an issue. But what the IRS said in November of last year was that even for these delinquent information returns that you're going to submit, basically they're sending out computer automated penalty notices now. So even though you may attach a statement with your reasonable cause and you file under these programs, what we're really finding more recently is that there's taxpayers are getting a lot of notices, and unfortunately, because of the IRS backlog in processing everything, it's just taking more time to correspond with the IRS, get in touch with the IRS, and get caught up and get them to recognize your reasonable cause and waive the penalties. So not something that's insurmountable per se, but definitely need to evaluate. We never really recommend what we call a quiet disclosure. So we don't recommend that you just file your tax returns and your FBARs and don't do it under a program or some type of come forward basis, because usually then you're going to be stuck with the penalties. And if the IRS comes to you first or the Treasury comes to you first, then these programs are usually off limits and not available to you. So definitely want to be on a coming forward type basis and come up with a plan to be able to get outside. And then for the last slide here, I just want to touch on this, and we are going to have a more in-depth webinar on this in the fall, but definitely a bigger issue is working remotely from the US. So you may be looking to move to the US, but you're going to continue to work for your Canadian employer, whether you're a key employee or somebody with unique job skills. So in addition to talking to Rosanna's firm about getting the proper authorizations to do so, there's definitely a tax perspective and impact as well. And physical presence here is the key. So for income tax purposes, where you're doing the work matters. So and this can have implications both to the employee and the employer. So depending on what you're doing for your employer, you could be giving your employer a permanent establishment, an office, effectively in the US, and maybe subjecting your employer to US taxation on whatever type of income you're generating for the company. And this can also give your company some state obligations, not just withholding obligations, but possibly sales tax obligations, possibly also income tax obligations there as well. So it's definitely something to be mindful of. Those two items, both the employee and the employer aspect, work in tandem under the treaty. So you can't just kind of, I've spoken with people recently who have making all these plans to come to the US, but they really haven't told their employer. They just think it's going to be okay for them to move down here. And that's probably not the case, and it's probably not something you want to spring on your employer at the last minute, hey, I'm moving to the US, and it's not going to be a big deal, because it very well may be. So that's something that, again, we can touch more on our next webinar in the fall, but definitely an emerging topic.
Great, thank you guys. That was a lot of good information you gave our listeners and some good things to consider and what to do next. We're going to take a look at the questions that were asked for our audience now. If you've not done so already, just enter your questions in the question box in the sidebar. But our first question looks like for you, Rosanna, does the company have to be profitable for years before applying for the L1?
Well, that's a great question. So remember, the L1 category is that intercompany transfer. You need to have an operation outside of the United States for at least 1 year. And that operation has to have employees, revenues, and the regulations require them to be actively doing business. That means it can't be a shell company. You're going to have to show payroll records, financial statements. So profitability really isn't the determining factor, but rather the government's going to look at, do you have purchase orders? Do you have contracts for your business? Do you have a team of people working there? Because the idea is the foreign business is strong enough and stable enough to support a worker going to the United States and transferring that key knowledge. So it is important for the foreign operation to be stable and doing business.
Great, thank you. It looks like my next question here is for both of you. I'm a Canadian and I can stay in the can I stay in the US for 6 months, right?
Yeah, if I had $1 for every time I was asked that question, I wouldn't be working right now. So there's this misnomer out there. Technically, the law says that you can remain in the United States for up to 183 days or 6 months, but that's not a given at the border. If you're 75 years old and a snowbird, you own a property in Toronto and you're going to Naples, Florida for 6 months, yeah, you can stay for 6 months. The US government's not going to care. You are retired, you're going to contribute to the US economy. But if you're 25 and you packed up everything and you're going to live on the beach in Florida, you're not going to be able to stay for 6 months. So it is discretionary, it's not automatic. People think they can come in, stay for 6 months, go back to Canada for a day, restart the 6 months. That is not possible. And the government will look at each situation on a case-by-case basis. Technically, the law says yes, but the reality of that is very different.
And then from a tax standpoint, physical presence here is the key. So it really doesn't matter. I mean, immigration status-wise, if you have a work permit or something like that, we're not really looking at that. Yes, we may look at that if you're generating wages while you're here, but from a purely physical presence standpoint, we're looking at the 183-day test. So if you're physically present for part of any day, which would count for 183 days in a given year, that would be the first test that would make you a U.S. person for tax purposes. And secondly, there's a 3-year window where the last 2 years are weighted. So if you do the math on all that, and you're over 183 days over a 3-year window, you could also be considered to be a U.S. person for tax purposes. So what does that mean? Well, by our statutory laws, yes, you may be a U.S. person, so you may have to file a 1040 and report all your worldwide income and all the things you may not want to report. But at the same time, we may be able to look at the U.S.-Canada income tax treaty and say, hey, yeah, I was really here for more than 183 days, but my business is still in Canada. My main home is in Canada. All these things, I still have these ties to Canada, these center of vital interests. So we may take a position under the U.S.-Canada tax treaty. Yes, I'm still a Canadian resident. I'm a U.S. resident or U.S. non-resident. So my only income may be U.S. income I've earned while I'm in the U.S. What that doesn't get you out of is the foreign bank account reports. It doesn't really consider the treaty. So if you're here for more than 183 days, you really should still be doing that FBAR or be subject to those $10,000 penalties. So there are definitely some far-reaching implications for you being here more than 183 days in 1 year. And so to do so kind of without a plan probably isn't a great idea. And definitely could make you have some U.S. filing obligations that you might not have otherwise considered.
Great, thank you. One more question, looks like it's in the box here for those that are able to stay on another minute. Again, looks like both of you are going to want to answer this one. I'm a Canadian citizen, but my wife is a U.S. citizen. We're looking to relocate to the U.S. Is there anything that we need to do?
Yes, so from the immigration side, just because your wife is a U.S. citizen doesn't mean you can enter the United States and live unencumbered. You need to get a green card, which you would qualify for by marriage through a U.S. citizen, but that process can take up to a year, and actually even longer right now. So if that is something that you're considering, strategically, we would look at an underlying work permit to get you in the United States quicker, and then file the ultimate green card. But just remember, you're not entitled to any type of automatic status if you're married to a U.S. citizen.
And then, yeah, and then from a tax perspective, really it's, again, what assets do you have? Are you, do you own a business? What is that going to mean for you? Also, green card / citizenship, of course, is a more permanent from a tax perspective, since we do tax based upon citizenship. So depending on what your plans are for the future, if you have that business or you don't want to be subject to U.S. tax on the worldwide income forever and ever, without going through an expatriation type process, then yeah, definitely something we need to look at as well. Also, if you are a green card holder here for more than 8 out of 15 years, you are considered to be a kind of permanent resident and subject to the exit tax should you decide to move to another country or leave for various reasons. So it definitely is more permanent in nature if you're going to be looking at that green card, but we definitely need to do a checkup basically of what you have on your personal balance sheet, what type of investments do you have from a Canadian standpoint, and then again, your spouse, have they been compliant too, because that's going to matter.
Great, thank you. Feel free to reach out to us anytime with some additional questions. If you have it, we're happy to answer those for you. Oh, it looks like another late one has come in. Do you have to have a house or property in Canada in order to apply for L1? We've been running our Canadian business for 10 years with some US customers as well.
So in terms of the type of business in Canada, we would look at it from a variety of factors. Typically, the government does like to see a traditional lease for the property in Canada to make sure it's a valid business. But if you've been running a remote workforce or what have you, we can certainly look at that and make a determination.
Great, thank you. All right, that's going to wrap us up for today. Everybody's contact information is on here. You can also find us on LinkedIn, both the corporate and the individual. And thank you for joining us today.